Condo owners, beware. Have you been hit with a special assessment from your strata? Today, we have a strategy on how to pay for it. Then, for first-time home buyers, we learn some creative financing ideas and discover how your financial advisor gets paid to avoid potential conflicts of interest. All this and more today on The Wealthy Life. How much do you think you should pay for financial advice?
I don't think you should have to pay for anything.
My advice is always to find somebody that has a flat rate, will not ding you per piece of advice. They make money off your money.
So I would advise everybody to go to you're paying for them financial investor, financial advice. It's $200 or $300, maybe a couple of $100, a couple of hours. It's the best decision you'll probably ever make.
Have you been hit with a special assessment on your strata or your condo? Today's guest is Jan Price, a retiree wanting to make a smart financial decision regarding her condo fees. Jan, welcome to the show today.
Thank you, Sybil.
Tell me your story.
Well, my career, when I actually did that, was first as a controller in a high-tech company in Vancouver, and then as a realtor here in Victoria. And then I decided to give myself a year off and travel.
Wow.
Because my mother had died very young, actually, and so I decided that I wasn't going to wait until I retired to do some of the things that were on my bucket list.
It was a bit of a wake-up call for you.
It was. So
must have been a hard time.
It was. But I took off and traveled around the world.
By yourself?
Yes, by myself.
What was that feeling like?
Actually, it was terrific, because one thing when you travel on your own, people are much more open to you and you're much more open to other people. So I met lots of absolutely great people. I was invited to people's homes. I traveled with people for short periods of time that I met.
Were you ever scared?
Actually, no. The only time I was even a little bit nervous was in Italy. And that's because there was a great spate of people just pilfering from people. So I just made sure, and I had kept things in all sorts of different pockets and places on my person.
So you wouldn't get robbed.
So if I got robbed, I wouldn't lose everything.
Now, did you have some attempted mugging type?
I didn't.
Or pickpocketing?
No, but I met people who did.
Yeah, it's kind of scary.
And that kind of did sort of...
So where was your favorite place out of everywhere you traveled?
Well, that's really difficult, because there are different favorite places for different reasons. But I ultimately really liked Greece.
Yes.
And there's more to that after I get back from my year's adventure.
Really?
So yeah,
so you came back?
I came back and fully intended to pick up my real estate career when I got back, and I just could not settle back in. And
you had the bug.
I had the bug, and I'd also really learned that there's so much more to life than this treadmill that we can get ourselves on, where we're just trying to amass bigger and better things. And I'd done that for a very long time. And so I decided I wanted to try living in another country for a year.
And did you?
And I did. So I had really loved Australia, but I would have had to go there as a professional, which was what I was deciding I wasn't going to do.
Yes, you wanted off the treadmill.
I loved Ireland, but the weather's not so great. And I had really loved Greece. And Greece, this was in the mid-90s, and it was a very easy place to be at that time. All I had to do was get out of the country every 6 months. So I'd take the ferry over to Italy, take the ferry back, and I was good to go for another 6 months.
Wonderful. And how long did you stay there in total?
I ended up staying there 5.5 years.
Wow.
Then I came back to Canada because I thought, well, Jan, you have to be a good citizen and top up your CPP and look after your house, because I did still own a house here, and do all of that. And then a good friend of mine in Greece who owned a business learned that she had terminal cancer, and she and her husband wanted to go back to England for her last period of life. So they phoned me here in Victoria and said, would you consider coming back for a summer to look after the bookshop? It's either that or we close it down. So I thought, I could do with another summer in Greece. This was
Fabulous.
5 years after I'd come back. And I went back and stayed for another 5.5 years.
Oh my goodness.
So I
But now
really only came back to Canada at the end of 2010.
Now that you're
permanently.
back in Canada, do you still own a house?
I do. Well, I have a condo. now.
Condo.
Yeah.
And what's your big question for me today, Jan?
Well, the big question is that I've been hit with a special assessment.
Ouch.
And it's whether I finance the special assessment through a mortgage or whether I take money from investments to pay the special assessment.
Well, I will answer that question for you, but not quite yet. Don't go away. Find out the better financial option to pay Strata assessments when we return.
The Wealthy Life is brought to you by investment dealer Raymond James. Life well planned. See what a Raymond James advisor can do for you.
Welcome back. We're here with Jan Price to find out if she should use her investments or get a loan to pay for her Strata special assessment. Well, Jan, you were telling us that you've been hit with this big special assessment. Did this totally catch you off guard? Did you know?
No, it didn't. We've
Okay.
known for 2 to 3 years that this was going to happen at some point, but D-Day has come, so to speak.
And kind of putting it off till later is appealing, but here you are now and you got to pay the piper.
That's correct.
When you bought your condo in the first place, did you have a look at what the contingency fund was like?
Yes, I did. And, for what people were talking about in 2010, it was perfectly good.
It was healthy, had a good balance.
It was healthy, but what's happened is I think that stratas in general we're certainly not funding to depreciation report status, and contingency fund was just that. Oh, it's a rainy day fund, and
Yes.
it looks like there's lots there for a rainy day.
And I'm
but-
glad you brought that up because that's something I observe as well. A lot of organizations, stratas, townhouse complexes, they keep their strata fees low intentionally because the owners want it low for cash flow purposes. They also want it low for resale. When people are going to buy a property that has strata fees, ooh, gee, the strata fee's too high, maybe I won't buy that property. The problem with that is it doesn't factor in depreciation.
Absolutely. It's such a fallacious way of thinking of things.
Well, the building is eventually going to fall apart. It will not last forever. And if you don't put a few percent per year of the value of the property away, you're going to be hit. I think for all of you watching, if you're part of a condo or a strata, put extra away. Don't worry about just the strata. It's not going to be enough over the long run. But here we are today, and you have a bill to pay. And what are your thoughts on that?
Well, I thought now I could just take money out of investments and be done with it and then not have to even think about it. But the fact of the matter is that I believe that my investments are earning more than certainly current interest rates, or even that interest rates would catch up to over the
Okay.
next few years. So I thought, well, maybe I should think about this a little bit more.
Yeah, think about borrowing. So you've got some experience investing. How would you rate your risk tolerance level on a scale of 1 to 10, 1 being low, 10 being high?
I'm probably right in the middle there,
Yep.
at about the 5 to 6 range.
Okay, and so a 5 to 6 range typically is a balanced portfolio. So you're right, the average rate of return on that type of a portfolio should be higher than the cost to borrow. And if that's the case, then it would make sense to borrow instead. How do you feel about monthly payments? Do you have the cash flow to fund a borrowing cost?
Yes, I do. And I know that if I do need to, prop that up a little bit, I can take small amounts out of my investments, but they're still earning more than the
They
amount
are.
that I would be taking out.
So the real things to consider is one, cash flow, making sure you have enough cash flow to fund the payments if you're going to borrow. And number 2 is making sure that the average rate of return on your investments is higher than your borrowing costs. So it sounds like, given your experience, that's the right angle for you, is to borrow. But for many of our viewers out there, make sure you get a second opinion, because if the markets go down, your investment drops, and you need the money to pay your debt, it's not going to be a great feeling. So it really is a personal decision. Jan, thanks for coming on the show today.
Well, thank you, Sybil, and thanks for answering my question for me.
Great. Stay tuned. Up next, we'll learn some creative financing options for first-time home buyers.
The Wealthy Life is brought to you by investment dealer Raymond James. Life well planned. See what a Raymond James advisor can do for you.
Are you wondering if your kids or grandkids are ever going to be able to afford their first home? With us now is David Steinberg, a mortgage broker with a special interest in helping first-time home buyers get into the housing market. David, welcome to the show.
Thanks, Sybil.
So tell me a little bit about your background. How did you get into this mortgage brokerage business?
At first, I was an account manager for a major bank, and I decided that I didn't want to work for a bank anymore, so I went out on my own.
And how's that been for you?
It's been really good. Thanks.
What do you enjoy the most about what you do?
I really get a lot of reward knowing that I'm helping people achieve their home ownership dreams. So it's, it's really rewarding knowing that I'm instrumental in helping people get into their first home.
And that can be an exciting, scary, stressful time all at once.
Definitely.
I remember buying my first home. Interest rates were 10%.
Wow.
And I locked in for 5 years before they went up.
Oh.
They didn't go up.
Right.
Oops.
Yeah.
Oh, well, I bought my first home and it was a good feeling.
For sure.
But saving the down payment is tough. What are some of the struggles first-time home buyers are dealing with today?
Well, with our housing prices in Victoria, our clients or our buyers have to come up with a much larger down payment than would be normal.
Yes.
So it's a lot harder to save up, let's say, $30,000, $40,000, $50,000. The other challenge that a lot of folks are facing these days is the Canadian government has made qualifying for a mortgage a lot stricter, so incomes have to be a lot higher to qualify for those higher mortgage amounts.
So young people today, they're graduating, they're going out and finding a job, but their income levels just may not be high enough to save a down payment, first off.
Right.
And second of all, to even afford the payments. They may not be able to even get into the housing market.
Right.
But I understand you maybe have a creative solution for that.
Right, yeah. And what I focus on with a lot of people is making it more of a family affair and getting the parents or grandparents involved in helping their children get into the market. So,
what would that look like? I think that's a great idea. But is it, hey, mom and dad, give me some money?
It's not just that. A lot of parents also don't have the funds themselves to give their kids $50,000 or $100,000. So that's where I really step in and start offering the parents themselves some options to perhaps refinance their home to help their kids come up with the down payment. And then the kids will come up with some sort of repayment plan with their parents to eventually get that money back to them.
Oh, I like that idea a lot. I'm not a big fan of just giving money to kids.
Right.
Because it enables them maybe some bad behaviors. And it feels so good when you can do it on your own. So you're saying the parents can use the equity in their own home,
right,
tap into it, and then lend that money to their kids or grandkids, or they could give it away if they want to give it away.
Yeah.
I mean, you can't take it with you either, so that's a personal decision.
And a lot of parents are happy to just borrow the money themselves and then gift the money to their kids because, with the high housing prices these days, the mortgage payment is almost just enough for the kids to handle with their monthly budget.
Now, how about joint ownership? Do you see that happening very often, where maybe the parent will co-own the property, so rather than just lending or giving them the money, they actually have a stake in the house?
We do, yes. A lot of parents will co-sign on the mortgage with their kids to help them also qualify for that mortgage. And then in 5 or 10 years down the road, when the kids can requalify on their own, the parents will come off the mortgage, and that'll be...
That's great. Well, I was 21 when I bought my first house at those crazy 10% rates. But my mom and dad did end up co-signing on the mortgage so that I could qualify for it.
Right.
And as soon as my income caught up to me enough so that I didn't need them, I had them removed because it was an independence thing for me. But I'm still grateful to this day that I had that support.
Right, right. And these days, a lot of parents are getting involved with their children and helping them get into their first homes because as we see housing prices just going up, it's just going to become harder and harder for younger people to get into homes.
And they're paying rent anyways, and I hate throwing money down the drain. So if their rent payment versus their mortgage payment are somewhat similar, the mortgage may be a little bit higher, but now it's for savings. They're building up equity in their future. They're creating wealth.
Right.
Which is fantastic.
Right.
So is it better for people to go into their bank, go through a mortgage broker? What are some of the benefits of working with a mortgage broker?
Well, working with a mortgage broker gives that client a lot more options to choose their different lenders. It gives the client a lot of options to choose different interest rates or different terms and conditions that are offered on different kinds of mortgages.
So more selection.
There's more selection, and it's also a much more personalized kind of service. You know, mortgage brokers, we will answer your call on the weekend or in the evening if there's something urgent, whereas I don't know if a bank necessarily would.
Probably not.
So it's just a much more personalized service. I find that I think the service is a lot quicker and a smoother process for the client. And of course, there's more selection with regards to rates.
Because there's so many things to consider. Best rate isn't always the best. You want prepayment options.
Right.
You want, is it portability, transferability? All of these things to think about. You don't want to get locked in and have these crazy penalties if you sell the property down the road.
Exactly. And mortgage brokers really just focus on mortgages themselves, whereas if you see somebody at a bank, they might be focusing on a range of different products to sell that client. So I find that when we have clients come to us, they really appreciate the fact that we do just specialize in mortgages.
And how much of a down payment does a first-time home buyer need?
The minimum down payment requirement is 5% down on any home under $500,000.
Oh, they've capped it. Well, that doesn't go very far these days.
Right, and on any on any portion of the purchase price above $500,000,
yes,
10% is required on that.
Now, if you're only putting the minimum down, CMHC insurance fees come into play, don't they?
Right. Yes, CMHC is the Canada Mortgage Housing Corporation, and what they protect lenders against the borrowers defaulting. So in a way they're acting as a stabilizer for the housing market in Canada. But there are insurance premiums that are involved when somebody is putting less than 20% down payment on their home.
That was going to be my next question. So as long as you have 20% down, you don't have to pay that additional one-time insurance fee at time of purchase?
Right.
So
for 99% of buyers out there. Some lenders may still require a CMHC fee even if the client has 20% down, but those cases are very rare.
And would credit rating and things like that come into play?
Definitely. Credit rating is very important, and also the income that you have to qualify for the mortgage also plays into the situation.
And so home buyers, no matter what scenario this is under, you really need to do your research, shop around for the rate, find out if you qualify. And we've got a great guide for those of you out there wanting to know how to best prepare yourself for borrowing money. Contact us at thewealthylife.com and we'll send you a copy of the mortgage guide. David, thank you for being on the show today. It was great having you.
Thanks so much.
When we return, discover how much your financial advisor really gets paid. Welcome back. Thanks for your letters, emails, tweets, and messages. Today's question is from Austin in Charlottetown. Dear Sybil, my current advisor told me she receives multiple types of fees, including something called a trailer fee, but she would not explain what a trailer fee is or how much she was receiving from them. I want to make sure I am not overpaying for financial advice, and I'm worried that I can't get a clear answer from my advisor. What types of fees is a financial planner going to charge me? What is a reasonable amount to pay in fees for financial advice? Many thanks, Austin. Austin, this is a great question and very timely. First off, I am quite concerned, as you are, that your financial advisor can't clearly explain the fees involved. Your advisor should know that and be able to explain it to you in a very clear, concise manner. All financial advisors get paid a little bit differently. There's different distribution channels for advice. I'm not sure if you've gone into your bank branch or a credit union, if you're working with a small independent organization or a large independent wealth management firm. The reason it's important to note the difference is so that you really understand how much you're going to pay, how much your advisor gets paid, and what's in it for you at the end of the day. Asking about fees alone is not good enough. You need to compare the fees you're paying with the true advice you're getting. So if you're in mutual funds, the average mutual fund in Canada will charge anywhere from 1 to 2.5% per year of the value of the money you have invested with them. Out of that, the financial advisor may get paid a trailer fee, which is what you were asking about, which is anywhere from 0.25 of 1% to 1% of that total fee you're paying. Now, some advisors are paid on a salary, so don't see the trailer fee, and maybe that's the case that you're dealing with. When it comes to financial planning, some full-service financial advisors offer financial planning services included in that total fee. Others do not, and you need to pay separately for it. To get an independent financial plan done from someone who is not charging you on investments, you're going to pay anywhere from an average of $500 to $5,000 and up, depending on how simple or complex your situation is. So as you can see, there's no quick, short answer, so I recommend you get a second opinion, and your advisor should be able to answer the question clearly. Thanks for your question. And that wraps up this edition of The Wealthy Life, helping Canadians make smart financial decisions. Go to thewealthylife.com to become a member and receive free exclusive access to Wealthy Life workbooks, calculators, articles, and more to help you make the most out of what you have.